A 20% return can be outstanding, ordinary, or disastrous. Until you know the risk taken, the benchmark used, the fees paid, and the path of returns, the number tells you almost nothing. This lecture reveals how risk-adjusted performance measures help separate genuine value added from market exposure, hidden risk, benchmark mismatch, and luck. We are going to study an extremely important question in investments. How do we measure investment performance properly? At first, performance sounds simple. We look at the return and ask whether the portfolio made money. But in finance, that is only the beginning. A portfolio may show an attractive return because the manager accepted large risk. Another portfolio may show a modest return, but that return may be excellent given the market environment, the client's mandate, or the amount of risk taken. So, the key question isn't simply, was the return high? The better question is, was the return appropriate for the risk, benchmark, constraints, and investment objective? Performance evaluation matters because it affects real decisions. Investors use it to decide whether a manager added value, whether a strategy should continue, whether fees are justified, and whether capital should stay with the manager or move elsewhere. Throughout this lecture, keep three ideas in mind: return, risk, and benchmark relative value added. Return tells us how wealth changed. Risk tells us how uncertain or uncomfortable the path was. Benchmark relative value added tells us whether the portfolio did better than a fair alternative. By the end of this lecture, you should be able to look beyond raw returns and ask deeper questions about skill, risk exposure, costs, and benchmark choice. Let's begin with the benchmark, because the benchmark is the yardstick for judging performance. A benchmark is the reference portfolio or index used to evaluate the portfolio. It tells us what the investor could reasonably have earned from a passive or policy-based alternative. Without a proper benchmark, performance evaluation becomes confusing very quickly. Imagine a manager who appears to outperform. Before we celebrate, we must ask, outperform compared with what? If the benchmark is too easy, the manager may look skilled, even when the result isn't impressive. If the benchmark is inappropriate, the manager may look unsuccessful, even when the portfolio did what it was hired to do. A good benchmark should match the mandate. That means it should reflect the portfolio's asset class, region, style, currency, risk profile, and constraints. A portfolio focused on one opportunity set shouldn't be judged against a completely different opportunity set. A good benchmark should also be measurable. We must be able to observe its returns clearly and consistently. It should be transparent, meaning we understand what it contains and how it is maintained. It should be investable or reasonably replicable, because the benchmark should represent a real alternative available to the investor. One more point is very important. The benchmark should be selected before evaluating performance. Changing the benchmark after seeing the results creates a serious interpretation problem. It can turn a weak result into an apparent success. So before discussing alpha, tracking error, or risk-adjusted ratios, always ask, is the benchmark fair? Now let's separate absolute performance from relative performance. Absolute performance focuses on the portfolio's own result. Did the portfolio increase wealth? Did it help the investor meet spending needs, preserve capital, or move closer to a financial objective? This is important because investors ultimately care about their own wealth and their own goals. Relative performance asks a different question. It compares the portfolio against the benchmark. Did the portfolio do better or worse than the relevant alternative? These two ideas can point in different directions. A portfolio can lose money in absolute terms, but still perform well relative to its benchmark if the benchmark did even worse. On the other hand, a portfolio can make money in absolute terms, but still disappoint if the benchmark did better. This is why raw return isn't enough. A raw return doesn't tell us how much total volatility the investor experienced. It doesn't tell us whether the portfolio had high market sensitivity, large benchmark deviations, leverage, liquidity risk, concentration, or downside exposure. Raw return also doesn't tell us whether the return came from broad market exposure or from manager skill. A high return in a rising market may simply reflect high market exposure. That isn't the same as value added. Before calculating any performance measure, we must also check the data. Are returns measured over the same time interval? Are they in the same currency? Are they gross or net of fees? Are portfolio and benchmark returns aligned properly? Now we move to risk-adjusted performance. The core idea is simple. We want to connect return to the risk taken to earn that return. Risk-adjusted measures help us avoid rewarding a manager merely for taking more risk. They also help us compare portfolios that may look similar on return, but very different in risk. There is no single perfect performance measure for every situation. The right measure depends on the question. A diversified investor may care most about systematic market risk. A client hiring an active manager may care more about benchmark relative risk. A downside-sensitive investor may care more about shortfall risk than ordinary volatility. Let's begin with the Sharpe ratio. The Sharpe ratio measures excess return per unit of total risk. Conceptually, it asks, how much return above the risk-free rate did the portfolio earn for the amount of total volatility it experienced? This measure is especially useful when the portfolio is the investor's complete risky portfolio, or when total volatility is the relevant risk. It is also useful when comparing broad portfolios that differ in asset allocation. A higher Sharpe ratio generally suggests better compensation for total risk, but interpretation requires care. The portfolios should be measured over the same horizon using consistent assumptions. If excess returns are negative, rankings can become unstable. The Sharpe ratio also treats upside and downside volatility similarly, but investors usually dislike downside volatility more than upside surprises. So the Sharpe ratio is powerful, but it isn't the whole story. Next, let's discuss the Treynor ratio. The Treynor ratio also focuses on excess return, but instead of comparing it to total volatility, it compares it to systematic market risk. Key idea is this: how much excess return did the portfolio earn for its exposure to market risk? The important risk concept here is beta. Beta measures how sensitive the portfolio is to movements in the market benchmark. A portfolio with higher market sensitivity tends to move more strongly with the market. A portfolio with lower market sensitivity tends to move less strongly with the market, all else equal. The Treynor ratio is most useful when the portfolio is only part of a larger, well-diversified investor portfolio. In that setting, unsystematic risk can be diversified away, so systematic risk becomes the main risk that investors require compensation for. This is a different perspective from the Sharpe ratio. The Sharpe ratio cares about total volatility. The Treynor ratio cares about market-related risk. So the same portfolio may look attractive under one measure and less attractive under another, depending on the kind of risk the investor cares about. The Treynor ratio is less useful when the portfolio isn't well diversified, when beta is difficult to interpret, or when the chosen market benchmark doesn't represent the portfolio's true systematic risk. The lesson is clear. Always match the measure to the investment question. Now let's turn to Jensen's alpha. Jensen's alpha measures abnormal return after adjusting for market risk. Alpha asks, after accounting for the portfolio's exposure to the market, did the manager earn more or less than expected? A positive alpha means the portfolio earned more than predicted by the risk model. A negative alpha means the portfolio earned less than predicted by the risk model. This is why alpha is attractive. It tries to separate market exposure from manager value added. If a manager earns a high return simply because the market went up and the portfolio had strong market exposure, that doesn't necessarily mean the manager added value. But alpha should never be interpreted mechanically. A positive alpha isn't automatic proof of skill. It may reflect genuine skill, but it may also reflect luck, omitted risk factors, stale pricing, leverage, sector exposure, or benchmark mismatch. A negative alpha is also not automatic proof that the manager lacks skill. It may indicate poor performance relative to the model, but it may also reflect a strategy that was temporarily out of favor or a risk model that failed to capture the portfolio's intended exposures. When alpha is estimated statistically, we should care about both economic meaning and reliability. A large alpha estimated imprecisely may be less persuasive than a smaller alpha that appears persistent and dependable. Alpha is useful, but it must be interpreted with discipline. Let's now look at active return, tracking error, and the information ratio. These measures are especially important when evaluating active managers. An active manager is hired to differ from the benchmark. The question is whether those differences created value. Active return is the difference between the portfolio return and the benchmark return. The formula is on the screen. When active return is positive, the portfolio outperformed the benchmark. When it is negative, the portfolio underperformed. Tracking error measures how much the portfolio's active returns fluctuate over time. In simple terms, it tells us how far the portfolio tends to move away from its benchmark. The information ratio connects these ideas. It measures active return per unit of active risk. The intuition is straightforward. Did the manager earn benchmark relative return efficiently? This is very useful because high active return alone may not be enough. A manager may beat the benchmark, but do so with very large and unstable benchmark deviations. Another manager may produce more consistent active return with less active risk. The information ratio helps us compare that efficiency. Tracking error isn't automatically bad. Active managers are supposed to differ from the benchmark. If a manager simply duplicates the benchmark, there is little reason to pay active management fees. But tracking error should be intentional. It should be consistent with the mandate, tied to the manager's investment process, and compensated by active return over time. So, for active management, ask not only whether the manager was different from the benchmark, ask whether being different was rewarded. Next, we discuss the Sortino ratio and the M-squared measure. The Sortino ratio modifies the Sharpe ratio by focusing on downside risk rather than total volatility. The main idea is this: investors often care more about falling short of a target than about volatility in general. This is an important distinction. Total volatility treats favorable and unfavorable movements similarly. But many investors don't complain when returns are unexpectedly strong. They are more concerned when returns fall below a required level, a spending need, a liability target, or a minimum acceptable return. The Sortino ratio is especially useful for portfolios where downside protection matters. It can be relevant for retirement portfolios, endowments with spending rules, liability-driven investors, and strategies designed around capital preservation. Its limitation is that it depends on the target return. Change the target, and the downside risk measure can change. That means the target must be clearly stated when comparing portfolios. Now let's turn to M-squared. M-squared translates Sharpe ratio logic into return terms. Rather than reporting a risk-adjusted ratio, it asks what return the portfolio would have earned if it were adjusted to have the same total volatility as the benchmark. This makes M-squared easier to communicate. Many investors understand return differences more naturally than ratios. So M-squared can be helpful when presenting risk-adjusted results to clients, boards, or investment committees. Together, Sortino and M-squared remind us that the best measure depends on how the investor defines risk and how the result will be communicated. Now let's bring the measures together. A good manager comparison begins with the mandate. Before ranking managers, we must ask what each manager was hired to do. Was the goal total portfolio growth, benchmark outperformance, market risk efficiency, downside protection, capital preservation? Different goals call for different measures. If we want to know whether wealth grew, we look at raw and compound returns. If we want to know whether the portfolio beat its benchmark, we look at active return. If we care about total volatility, we look at the Sharpe ratio or M-squared. If systematic market risk is the focus, we look at the Treynor ratio and Jensen's alpha. If benchmark relative efficiency matters, we look at the information ratio and tracking error. If downside risk matters most, we look at the Sortino ratio and downside deviation. But performance metrics aren't enough by themselves. We must also examine qualitative evidence. Did the manager follow a repeatable process? Were the holdings consistent with the stated strategy? Was performance concentrated in a narrow decision, a single market environment, or a small group of positions? Were fees, taxes, liquidity, and capacity considered? Did the manager take risks the client didn't intend to accept? These questions matter because performance evaluation isn't just a mathematical exercise. It is a decision-making process. The best interpretation combines quantitative measures with professional judgment. Ratios can guide us, but they shouldn't replace thinking. A performance measure is a tool, not a verdict. Let's finish with a disciplined way to interpret outperformance. When a portfolio performs well, the central question isn't simply whether the return was high. The central question is why the portfolio outperformed. Outperformance can come from genuine skill. It can come from intentional risk exposure. It can come from unintended risk exposure. It can come from benchmark mismatch. It can also come from luck. So the evaluator should move carefully. First, confirm that the benchmark matches the mandate and opportunity set. If the benchmark is wrong, active return and alpha may be misleading. Next, separate market exposure from active decisions. A portfolio with high market sensitivity may perform well in strong markets simply because it accepted more market risk. Then examine factor, sector, style, currency, credit, duration, and other relevant exposures. Apparent alpha may actually be compensation for risks not captured by the model. Also review concentration, downside risk, and implementation. Fees, trading costs, taxes, market impact, and cash drag can reduce what the investor actually receives. Finally, look for persistence and process consistency. Skill is more convincing when performance is connected to a clear investment process and observed across different market environments. The common mistakes are easy to remember. Don't confuse high return with skill. Don't use the wrong benchmark. Don't ignore fees. Don't confuse beta with alpha. And don't rank managers using only one ratio. Thank you for joining me today. I hope this lecture helped you see performance evaluation as a disciplined framework rather than a simple return comparison.